Welcome to The Explainer. Today, we're digging into a really fundamental question in global finance. Why isn't a dollar always worth a dollar depending on where it is in the world? We're going to uncover the hidden formula that really governs the price of money across borders.
You know, it all starts with a question that seems pretty simple on the surface. If you take all the currency risk off the table, shouldn't an investment in one country earn the exact same return as the same investment in another? I mean, that makes sense, right? Well, the answer is way more complex than you'd think, and it's really the key to this whole explainer.
So, here's our game plan. We'll start with the elegant theory behind it all, then see how it's supposed to work, with a really clear example. After that, we'll uncover the real-world glitch that the pros track every single day, and finally, we'll get into why this tiny detail matters to, well, pretty much everyone.
Okay, let's dive right into our first section. We're going to talk about the core concept here, which is basically the fundamental no free lunch rule of international finance.
And you know what? This big idea, it's not new at all. It was actually introduced over a century ago by one of the most famous economists in history, John Maynard Keynes.
The theory itself is called covered interest parity, or CIP for short. The simplest way to think about it is this. It's a rule that says once you use a financial contract to lock in a future exchange rate to cover your risk, your investment returns should be identical, no matter where you are. No arbitrage, no free lunch.
Okay, enough with the theory. Let's see how this beautiful idea is actually supposed to work in practice. We'll use a straightforward, concrete example with the US dollar and the Mexican peso. Now, what's so cool about this is that we can take all this publicly available data, the current exchange rate, the official interest rates from both the US and Mexico, and actually watch this theory come to life. So when you plug those numbers into the standard CIP formula, it spits out a fair price. Basically, what the exchange rate should be a month from now if you want to lock it in today. And in this case, that number is about 17.54 pesos per dollar. And here's the magic. If you go and look at what the actual market is quoting for that 1-month rate, it's incredibly close to our calculation. This is the proof, right? CIP isn't just some dusty academic theory, it's a real live pricing rule that the entire foreign exchange market is built on. But, and you knew there was a but coming, right? It's not always a perfect match. Sometimes, a little gap opens up between the theoretical price and the actual price in the market. This gap, this little real-world glitch, it has a name.
It's called the cross-currency basis. Just think of it as a little bit of friction in the global financial plumbing. It's a sign that things aren't flowing perfectly smoothly, and it's usually because there's a bigger demand than supply for a specific currency, like the US dollar.
So, how do the pros measure this gap with any precision? Well, they're not guessing. They use real-time data from financial futures markets to get an exact reading on it. All right, let's get our hands dirty with a real-world example. Using some futures contract data from CME Group for the euro versus the US dollar. This table right here, this gives us all the pieces of the puzzle we need to find that hidden basis. We're just going to follow 3 simple steps. First, we'll see what the market is actually charging. Second, we'll calculate what the theory says it should be charging. And third, we'll just compare the two and see what we find. So let's get started with step 1, finding the real market price. To do this, all we have to do is look at the 2 Euro FX futures prices from our data table, the one for September and the one for December, and find the difference between them. The math is simple. It's a difference of 0.0049. Now, in the world of foreign exchange, they call that 49 pips. This is reality. This is what the market is actually charging to swap euros for dollars in the future.
Now for step 2. Let's calculate the theoretical price. Here, we're going to use the interest rate futures from our data to figure out what the price should be, according to that elegant CIP theory we were just talking about. So after running the numbers through the formula, the theory tells us the price should be 47 pips. Okay, so keep that number in your head. Theory says 47.
And there it is. This is where it all comes together. The theory says the price should be 47 pips, but the real-world market is actually trading at 49 pips. That 2-pip difference, that's our glitch. We found it. That 2-pip difference is the cross-currency basis. And when we translate it into interest rate terms, it means there's an extra cost of about 7.3 basis points, which are just hundredths of a percent, on the euro side of the transaction. It's a hidden funding cost that the simple theory just doesn't see. So, here's the crucial question. Why should anybody care about a seemingly tiny 2-pip difference? Well, because in the world of global finance, tiny differences can mean millions or even billions of dollars.
And this number isn't just for traders on Wall Street. Imagine you're a corporate treasurer deciding whether to borrow money in dollars or euros. This glitch tells you the true cost. Or if you're pricing a giant multi-year construction project overseas, this number helps you set a realistic budget. And if you're a risk manager, you are watching this thing like a hawk because ignoring it can lead to massive, unexpected losses.
Ultimately, this one little number tells a really deep story. When it gets wider, it can be a signal of stress in the global banking system. It's like a barometer for the health and efficiency of the entire world's financial plumbing.
So what we've really seen today is that even in our hyper-efficient, high-speed markets, these elegant theories don't always match up with messy reality. It's in these glitches, these little gaps between theory and practice, that both risk and opportunity are hiding. And that leaves us with a fascinating question. Where is the next glitch? And what valuable insights are hiding there in plain sight?